Hi, everybody. I wanted to talk about another of my favorite dividend stocks. This one's a little riskier than the last one I mentioned on the show, Realty Income, but this is EPR Properties, ticker symbol EPR. This is another real estate investment trust or REIT, but they have a slightly different and unique focus. They focus on what are called experiential properties, meaning properties that sell experiences, not actual products. Just to give you an idea, the biggest single type of property in their portfolio is movie theaters. They also have a substantial amount of eat and play properties. Topgolf's an example of one of their largest tenants in that category. They have attractions like water parks. They own a bunch of ski resorts, Vail Resorts. The you know most iconic ski resort operator in the world is one of their tenants. They have experiential lodging properties. I think they own a Margaritaville hotel, just for an example there. They have a couple gaming properties, fitness centers, cultural attractions, and they also have a small portfolio of educational properties, such as early childhood centers and private schools, but they're trying to get out of that part of the business. So I'll talk about that a little bit more in a second. But they've been around since 1997 when they went public and have handily outperformed the S&P 500 since then. Not so much in the past few years because they were hit hard by the COVID pandemic because their biggest focus is movie theaters. So obviously that wasn't a great place to be. But the economics of this business are pretty solid for long-term investments. I'll get to the concern with the movie theaters a little bit later. But their tenants sign long-term leases. The average lease term they sign is 14 years long. They have built-in annual rent increases, also known as escalators in the real estate world, right, built right into the lease. And the recent, since the pandemic, the results have really showed how resilient this type of property is. The big fear when COVID hit and the EPR completely plunged, it fell off a cliff at the beginning of the pandemic. The fear was that people weren't going to want to go out in public and gather anymore, and that the world was going to change forever, and people were going to be a lot more fearful about gathering in groups. Obviously, that didn't happen. We've seen in the past year or so that the younger generations, especially, really want to get out and have experiences. There's a lot of pent up demand from all age groups, but the younger generation in particular is really kind of eager to get out and live life to the fullest right now. Um, just to name one study, EPR found that 44% of millennials and Gen Z people plan to go out more to eat than they did before the pandemic. So that things like that are favorable for experiential properties. It's a great dividend stock. It pays a 6.4% dividend yield that's well covered by its earnings. EPR remained profitable um, even during the middle of the pandemic. It remained profitable because its cost structure is so low. It has very little overhead. Um, its monthly dividend payment adds up to, like I mentioned, a 6.4% yield. It's well covered by its FFO. It makes monthly dividend payments, which is kind of a cool feature, especially if you're retired and rely on your investments for income, because who wants to wait every 3 months for your next paycheck? Um, there are a lot of risks here, especially in regards to a stable REIT like Realty Income that I mentioned. The tenant risk is the big one. They're 41% of their rental income comes from movie theaters. They're actively trying to diversify away from that by both buying additional product properties in other areas, as well as by strategically, hopefully, disposing of a few of their movie theater properties. But for now, it's a pretty big risk. AMC is their biggest tenant. Regal is one of their biggest tenants, and Regal just announced they're exploring strategic alternatives, which could be bad news for their landlord, EPR. And that accounts for 14% of rent and is a big reason the stock is trading at a little bit of a discount right now. Um, Even if the tenants are fine, these tend to be very cyclical businesses. People spend less on things like going to Topgolf and going to water parks and going to skiing in recessions and other tough times. So what I'm watching going forward, I'd like to see the diversification away from movie theaters really start to kick into full gear. The percentage of rent that comes from theaters has declined from 46% to 41% since before the pandemic. I'd like to see that keep moving in that direction. EPR has a lot of cash on and credit on its available to it. $168 million dollars in cash and a $1 billion untapped credit line it can go after new properties with. That's a lot of liquidity for a small cap REIT like this. They see $100 billion of investable properties in its universe. It specifically called out things like gaming as a big expansion opportunity. Cultural attractions like museums, amusement parks are an area it could get into. Marinas and concert venues are just a few examples of where it sees its portfolio going. I mentioned about 7% of its properties are education in nature. It's actively trying to diversify away from those or exit the education business entirely. It had a portfolio of charter schools that it sold not long ago, and hopefully it gets rid of the other education properties too. That'll free up even more liquidity that it can invest somewhere else. So EPR invested a little over $200 million in the first half of the year and anticipates its investment spending really kick into high gear in the second half. So that's definitely something to keep an eye on. But again, very reasonable cost structure. EPR has very high margins. It stays profitable no matter what the economy is doing. Even if it did have to cut its dividend during the pandemic, it didn't have. There was never any risk that the company was really going to go out of business or anything like that. But definitely not a low risk dividend stock, but it's not a high risk one either. It's one that I have in my retirement account. And it's a really interesting company, especially if you believe that people want to gather and want to get out and want to experience things, and that trend will continue for the foreseeable future. So that's today's installment is EPR, and hope you enjoyed this video. Thank you. This video is sponsored by the Motley Fool. Check out the link in the description to receive the top 10 best stocks to buy now, or visit fool.com/Frankel.